Good morning, hello and welcome to a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleagues Sonia and Nigel. Guys, hi, good morning.
Good morning.
Hi, good morning. This week has flown by. I mean, it was just like, I guess, a few hours ago we were talking about Monday and now we're here on Thursday, right? So, but I guess for the bulls, not so much because it's been sort of a heavy week where the bulls have been pretty much on the back foot. But, you know, if you look at what's been happening so far, the bears have been in complete control of this market. So just a couple of things that I want to point out as we kickstart trade. It's been, what, the fourth straight day of losses. So I guess that's something that would irk a lot of people on the street.
You know, 4 days, Sonia and Nigel, the Nifty has lost 600 points. The Bank Nifty is down 1,300 points, right? So it's been fast and furious in the coming. And that kind of, at the margin, raises the hope that can this continue without a new, fresh trigger at the same pace down? I think not. And we'll talk more about that. But let's just start with the beginning, right? The very beginning in terms of what the cues from overnight are. So you've got US stocks which actually closed absolutely flat. This is after the 2% fall that we had on Tuesday. The close is on your screen, the S&P and the Nasdaq. The Nasdaq actually was up a little bit. The S&P was still down. I'm not getting into the intraday moves. I mean, the market was up at one point, then it lost after the FOMC minutes. That's besides the point. The close was flat. The FOMC minutes reinforced Fed's hawkish commitment. This is the data point which many were wanting to watch, despite knowing fully well the minutes for which the meetings, the meeting for which the minutes were released yesterday happened before the string of strong data. You know, the jobs number and the CPI number and the PPI number and the services PMI, etc. So this is kind of pre all the strong data points. But in any case, even then, you know, there were hawkish edits to an otherwise, I would say, stale minutes. And the hawkish edit is simply the fact that the minutes did not discuss a pause, right? And I think this is something which lends that hawkish kind of tinge to the entire meeting minutes. So no help from there, really. Let's put it that way. The 10-year closed flat. I mean, it almost got to the 4% mark, 3.97 it is where it got to, and finally left off at about 3.92. Day on day, it was flat. The dollar index is still, though, higher at about 104.4, 104.5. So this is stronger. The dollar is not really pulling back, and expectations are growing with the positioning in the dollar cleaned out. People were more willing to go short the dollar, but that's kind of, you know, reverse. And maybe the dollar strengthens a little bit. You've got to look at the dollar, the euro dollar cross or the JPY dollar cross, and the dollar is looking stronger against some of the major ones. All right, let's get to the market here, right? As I said, the Nifty has lost 600 points in the last 4 sessions, and the Bank Nifty is down 1,300 points in the last 4 sessions as well. So you add to the mix the fact that, you know, yesterday, for example, we did not have very large, and actually this is not just true yesterday, but the last 2 days, the sell flow numbers from FIIs, etc., has not been, institutions has not been humongous. I mean, so the fall is not supported or is not borne through by very large institutional sell flows. So with that said, what are we watching out for? I would still kind of put out the downside numbers first. We are watching the 17,585 level on the Nifty. We'll put out a chart to this effect in a little bit from now. If you join the level from the lows of June, 17th of June 2022, when that big correction happened and the big rally, it meets straight up to the low of the 1st of February 2023, which is the day of the budget, and you extend it through, it meets the Nifty at 17,585. We left off yesterday at 17,554, which is slightly under it, 30 points under it. So that becomes a important pivotal kind of level. The budget day low has again, unfortunately, come back into focus, but I think that's the big one to watch. 17,353 is in that sense, the big support to watch. I mean, beyond that, then you get into looking at sort of, you know, longer term 20 weekly moving averages and things like that. I think we have the chart which may kind of make that point. This is what I put out yesterday on the Nifty. From the lows of June 17, 22, 1st of Feb 2023, and it meets the Nifty at 17,585. So that's the level in the very near term around which the market is closed. It becomes important. On the Bank Nifty, it closed below the 61.8%, the golden retracement of the entire rise, right? The big support for the Bank Nifty comes in at 39,420. We left off yesterday at about 39,995. upside levels, I think we can kind of, start to pencil as the market shows a little bit of enthusiasm, but the structure is weakened quite a bit. And I think bears are feeling more confident that when, and you could have seen that all day yesterday, day before yesterday, 30, 40-point bounces, which were getting easily sold into. And I think that tells you that maybe for the time being, things perhaps remain a little down and out. But will we continue with the pace of fall that we've seen over the last 4 sessions? I would say it should moderate a little bit. Guys, hi.
That was our question, right, over the last many days, and which way will the range break?
Yeah.
And now it seems like the range could break on the downside. At least that's the trend we've gotten over the last couple of days. 4 straight days of losses, as we've been telling you. And on the Bank Nifty, this year already, the Bank Nifty is down about 7%. But if you map it from the highs that we saw in December, the Bank Nifty is down 9% from December highs. So this definitely, that whole piece has broken down and is not giving any support to the bulls. FIs as well sold almost 600 crores in the cash markets yesterday. So once again, the FI numbers are rising. And the Nifty is now testing the 200-day moving average of 17,349. So that's the level I'm watching very closely on the downside. Now, of course, Prashant was talking about how the Fed's peak was a bit on the hawkish side. They've showed a resolve to fight inflation with rate hikes, and a few officials are also talking about a 50 basis points rate hike. So that's kept a lid on the market gains. You've seen a big fall in crude, Brent crude overnight as well. Now, a couple of things to watch out for today. One, of course, it's F&O expiry, and the bias has been on the short side, on the sell side. So that weakness could shape up today as well. There's a lot of global data coming through, especially from the US markets, whether it's the US GDP data, the weekly jobless claims that's due. You have a lot of earnings coming through from the likes of Alibaba, Bath and Body Works, Papa John's, etc. in the US. So, the consumer story has been weakening there. We saw it with Walmart and Home Depot. So these numbers will also assume importance. But give and take everything, it looks like the bears have tightened their grip on the market now, and that's not going anywhere, at least in the near term.
Well, that's right, Sonia. In a weak global cues, you have expiry as well that will play out, and the rolls are not very, very high. So today, expecting a fair bit of volatility, particularly in the second half of trade. So that's the picture as we speak. And yesterday, the problem was the key technical levels did break out. That 17,750, it broke in the first hour itself. And yesterday was a perfect day where you understand the importance of a stop loss. Because at 17,720 to 17,750, once that level broke, any kind of bounce was getting sold into. Now, we're due for a bit of a relief rally, though it's unlikely to be long-lasting. And maybe in the near term, we're a bit oversold. Now, the Nifty looks vulnerable till that 17,850 to around, 18,000 odd mark, till we get past that band. The bulls will feel good if we get past today without breaking that 17,500. And that's what positioning is showing. What do the FIs do in the F&O market? Well, yesterday, getting into expiry day, they added 40,000 short contracts. That's 4 shorts for every 1 long position, and that's perfectly how the setup has been, because the shorts are at around 77% or thereabouts. They also wrote calls. They wrote calls aggressively. 1.4 lakh calls is what's written. So they're shorting the index and they're writing calls as well. Now, the PCR has moved to sub that 0.7 odd. Normally, we have seen a bit of a bounce in that 0.65 to around 0.7 odd. And that's because yesterday, just take a look at the call writing. Getting into expiry day, you have more than a crore shares written at around 17,700 and 700 odd. So we're not unlikely to see that level. 17,600 though, there's a lot of confidence out there that the bears are showing, because they believe that 17,650 level will hold out. So that's why there's aggressive writing out there. While on the downside, 17,500 put, well, that did see some bit of writing. So just plugging in those numbers, because some bit of writing was seen at around that 17,500, that could be the final frontier actually for the bulls. They're hoping that the 17,450 odd level holds out. The call writing we saw, so that's why resistance at around 17,650. And the bulls definitely don't want to see the lows that we saw on budget day, but that as well comes up for you on the screen. We're likely to open up with a gain of around 50 points. That will likely to get sold into, but hopefully we don't break 17,500 odd mark. Maybe a couple of positives that could play out. One is the IT index, because the Nasdaq stabilized overnight, and Brent crude prices down $6 in the last week or so.
All right, Nigel, thanks very much for that. So that's the cues as we are seeing it as we start another session. Well, before we go any further, let's quickly tell you what is lined up here in the first half hour of the show. We get you updates from markets across the globe. Jahangir Aziz of JP Morgan, Rupal Agarwal of Bernstein join in to discuss the global trade setup. Our research team brings you CNBC-TV18's list of top 10 stocks to watch. At 8:30, we talk markets with Aditya Suresh of Macquarie.
Okay, this morning we have two market views coming up for you. First one is from Vikas Jain of CLSA, who says their analysts have upgraded revenue forecasts for FY24 and FY25 by a small 2 to 3%, but have cut the EBITDA margins by 40 to 30 basis points. He says all the sectors saw an EBITDA margin contraction except IT and staples. He also says Nifty consensus EPS was cut by 0.9 to 1.5% for FY23, 24 and 25. He stays cautious and they have adjusted weights in their India portfolio to make space for GAIL, a utility defensive and value pick with imminent trigger. He also says they have added Eicher Motors, a premium urban consumption and GARP play to get exposure to the growth in the auto sector. So two stocks, GAIL and Eicher Motors on their list.
All right, Sridhar Shivaram of Enam Holdings is also weighing in. He says the first half of the calendar year 2023 will be tough for equities. He says the macro numbers look challenging and protection of capital should be the mantra. Their view is that inflation will remain higher for longer, both in India and the US, and they expect 25 to 50 basis point rate increase in India. Hence, he says it would be prudent to be cautious.
Okay, so that's a cautious view coming in from Sridhar Shivaram. But let's get you some money market views as well. Parul Mittal Sinha of Standard Chartered says the dollar INR traded in a narrow range last week amidst upward move in the US dollar and higher US rates. She says $83 continues to be a psychological resistance and she expects the 82.25 to 83.25 range to hold. She says hawkish FOMC minutes will weigh on Forex and further moves would depend on global data, especially from the US amidst range-bound crude oil prices and sharp narrowing of the current account deficit in Q4 of FY23.
On bonds, she weighs in. Parul Mittal Sinha says global yields continued their up move on repricing a further Fed rate hike expectations, buoyed by hawkish FOMC minutes. She says in line with the rise in global yields, domestic yields have also inched up. Her view is the 10-year benchmark bond yield is expected to trade in the range of between 7.35 to 7.45 next week. She adds the MPC minutes were hawkish, in line with policy statements with no explicit guidance on future actions. However, she assigns a greater possibility of a hike in the April policy.
All right, we have a lot of stock-specific action that we'll be tracking for you and get to that in just a bit in our special Top 10 segment. Well, we have Gujarat Gas, Mahindra CIE, Crompton Greaves, HE Infra, Lemon Tree Hotels and Sandur Manganese. They are stocks on the back of positive news flow. On the flip side, you have Sonata Software, Z Entertainment, Orient Cement as well as Delivery. They are stocks that could open up in the red.
All right, so those are stocks which we will get to in just a bit from now. Jahangir Aziz is head of emerging markets, economics research and commodities at JP Morgan, and Rupal Agarwal is senior research analyst, Asia quantitative strategy at Bernstein. Guys, thanks very much for joining in. Good morning. Great to have you with us here on the program. Jahangir, we've again kind of seen a bit of a regime change in terms of how markets approach data. Good was good, now good's become bad. A string of good data and markets are sulking. What do you make of it, and what next, according to you?
Look, I mean, most of the reason as to why the market is reacting the way it is because, if you go back to October, November of last year, recession fear, and also which was combined with that, core U.S. prices were going down, inflation was going down. All of that combined to actually ease monetary and financial conditions significantly during that period of time. The 30-year mortgage rate fell almost 90 basis points, the 10-year slipped about 75 basis points. The dollar eased, and the equity market, recovered quite strongly. And I think that easing of financial conditions was clearly not the way in which the Fed was looking at things. And I think that after discounting the Fed for a very long period of time, I think the January CPI number and then the revision of core inflation up from 3% run rate of the last 3 months to 4.5% run rate, and then the string of very strong employment numbers along with ISM numbers, PMI numbers, etc., suggested that the market was probably had moved too far away from the Fed. And over the last 2-3 weeks, we are seeing the market gravitate towards the Fed. So I really don't think that good is bad and bad is good. I think that's been the norm for quite a while, Prashant. So that's not something new. But I think that market is finally tightening towards the Fed after discounting it for a long period of time.
Okay, retightening. I like that. Rupal Agarwal is also with us. Rupal, what do you see as the end game of this Fed tightening cycle? Do you think the Fed can avoid a recession, achieve a soft landing for the economy that sees perhaps growth slowing considerably but not contracting?
So I think, the way that the data has started emerging, it seems like it looks as of now more of a soft landing than a hard landing. And that is exactly how the markets had been reacting, to all the very, very strong data that we've seen from the job market. In fact, even the consensus broadly does expect more of a soft landing than a hard landing. And that's actually one of the reasons why we think that it's better to actually rely on the market rally and be more risk on in the shorter term before we see hard evidence emerging of this becoming more of a deeper recession than what the markets are pricing in. So we do think that there are risks out there. One needs to be more cautious around them. But in the shorter term, because of the fact that inflation has largely peaked, yes, rates are likely to remain higher at for a much longer period of time. One needs to be more cautiously optimistic, but I think in the shorter term, there will be again somewhat of a hope rally that we can expect.
All right. Hi, Rupal. Good morning. Rupal, you've mentioned in the past, I think, that China, Taiwan, Korea, they are preferences from the Asian markets, while India, because of these valuations, well, you're a little bit cautious out here. We've seen some correction, 1,000-point correction on the Nifty. What valuations do you believe that the Nifty could start bottoming out? Because still earnings are elevated. We still need to see earnings pullbacks. And maybe, in fact, that 1,000 rupees on the Nifty EPS, maybe that's not coming in the near term. Go ahead.
Yeah, so I do agree that, valuations, the way that they were looking too stretched at the beginning of the year, we've definitely come down quite a bit. We are now back to one standard deviation above the longer term mean, which is clearly better than, say, when we started at around 1.8. But relative to all the other markets, India is still, the most expensive to its own history, and relative to, say, emerging markets. So we are still quite expensive. And also, the point that you made, we do think that the earnings downgrade cycle is going to accelerate from here. And hence, valuations at this point don't look justified. The other interesting aspect is that investors are actually now demanding higher equity risk premium, which was not the case for the last 3 years. And in the light of, the yields still remaining higher, and even though the pace of tightening has moderated, within India as well, we're still looking for rate hike cycle to continue, which means that, in that context of higher yields, we don't think the current valuations, again, are justified. In fact, if we go back and look at historical trends, at 7.3, 7.4% 10-year bond yields in India, markets should have been trading somewhere around 18.5. We're not yet there. So I would say the rate hike cycle that we've already seen has not been priced in, and there's more to come. And hence, valuations in this entire light doesn't look sustainable.
1.5 is the PE multiple, right?
Yes.
So, and currently we're closer to around 20.
Currently, we are closer to around 20, yes.
So just extrapolating that, maybe in fact, it opens up a downside of close to around 10% or, odd from these levels as well.
Absolutely. And in fact, I would say that even from a sentiment perspective, that 10% drop could be a big positive for a lot of foreign investors to come back to India. That has definitely come up in some of the recent conversations that we've had with investors, that something in that range could actually make them come back, and take some more exposure in India.
Jahangir, so in terms of the where we are, right? Is this a slight pause in sort of disinflation that we are seeing globally? Will one weaker, softer data do it once again to swing everybody on the other side? Well, all is well and good, or you think these expectations that it's going to be hard, inflation is going to be hard to beat? That's the feeling, expectation, which is getting entrenched now. What's your sense?
So I think, you are going to get surprised by the strength of the core inflation. I think people are not the entire expectation was that headline inflation would come down, and that was because of the massive spike in food and energy prices during the same period of time last year. And I think you need to wait for that to happen. Most of the spike took place after the beginning of the Ukraine war. So that would be March and April. So you need to have patient enough to wait for March and April to come. And I think you will see the very large disinflation taking place. But core inflation was going to remain tight. I mean, that was always on the cards. And what you're seeing is that core inflation is surprisingly the upside. And that perhaps is where the market is getting pushed back, at least core inflation in the US and also in India. But I think that the big disinflation, you still have to be patient and wait for that to happen. But I don't think that the market is going to, at least by market meaning the US market, is going to get swayed by large disinflation in emerging market countries. It needs to see that happening in the US, and that looks much more difficult today than, let's say, a few months back. But I think that the Fed was very, very calm in the last 3 months of last year when recession fears were skyrocketing and core inflation was coming down. And I think that they're going to be also calm by looking at the January numbers, etc. And I think that the fact that the market is now re-tightening towards the Fed, I think will give them solace. So we do expect the Fed to remain on this 25 basis points hiking for the next two FOMCs.
Okay, Jahangir, a very quick question, if we can wrap up in a minute. Did you take a look at the minutes of the MPC meeting? Because that indicated as well that the committee believes that it's not a time to pause even here in terms of rate hikes.
Sure.
If that is the case, then do you see it hit growth and demand? Because, inflation is definitely pinching pockets.
No, that is not true. If you look at the big parts of U.S. inflation, the one that is surprising you is non-rental services. That's the one that's going up. But compare gas prices 6 months back and today. I think what is actually driving the economy is the fact that you still have about a significant amount of household savings rate, and you're getting a relief from gas prices going down and headline inflation coming down from the 10s to the 6s, and that's keeping consumption up. So I think it is going to be very difficult to see how, unless you keep on raising rates and keeping it high for a long period of time, how this economy slows down.
All right, we'll leave it at that. We've actually run out of time, but not out of questions. Thanks a lot for joining us. Rupal and Jahangir, appreciate your thoughts. We'll slip into a quick break, but plenty of stocks to focus on when we come back. Our entire research team will be joining in. Back to Bazaar Morning Call, where we have our entire team joining in now to help us prep for the day. So let's get all of them going. Plenty of stocks actually today. It's flooded in terms of news flow. So let's get straight to it. Gujarat Gas is first up on our radar. Sonal is here to give us the latest. Sonal, over to you.
Good morning, Sonia. Well, it is a surprising move where the company has gone ahead and increased prices. This is via lowering their discounts on the commercial PNG side. There's an increase of 1.5 rupees per SCM to 49.5 rupees per SCM now. That is what the commercial customers will have to pay to Gujarat Gas. Now, remember, it is still lower than propane prices. So Gujarat Gas tends to benefit from this because that will meet higher volumes versus the competitor. And the company had earlier guided for volumes in Morbi region, which is the majority of their revenues in the commercial segment, to go up to 3.5 MMSCMD versus 2.2 MMSCMD in Q3 that they had seen. It is a positive for Gujarat Gas, of course, higher volumes and higher prices as well. But it is surprising because, remember, natural gas prices, they've come off 50% from the peak, and despite that, they've taken a price hike. So definitely not a good news for customers.
Okay, thanks a lot for that. Well, the stock I'm tracking this morning is Mahindra CIE. It came out with its numbers yesterday. These are the Q4 calendar year ending numbers, and they looked very good. So the total revenue growth for Mahindra CIE has gone up 26%. The EBITDA has risen 93%. Now, this is the reported EBITDA, but this includes a one-time impact of a 38 crore amount that they received as profit on their land sale. But even if you exclude that, the EBITDA is quite healthy at about 15.7 to 16%. Now, the growth has come in from the Europe business, and it's interesting because, as we know, Europe was under pressure. But now the automotive market is showing a recovery because the semiconductor shortage is easing, as well as, if you look at it, the energy and energy prices have stabilized and the inflation extra cost has been passed on to consumers. So the European business also did well. Sales up 43%, EBITDA up 88%. I'm going with green on the stock. In any case, this stock has outperformed the auto index quite a bit. So green over there.
Okay, all right. Going with green now. They are going across to Manglam. Then Manglam, Sonata Software, they announced a rather large acquisition this morning.
It is a rather, yes, Nigel, it is a rather large acquisition that Sonata Software has announced. In fact, they've gone ahead and acquired Quant Systems, Inc., which is a Texas-based IT services corporation. And here's why it is large, because the terms of the payment, upfront they have to pay around $65 million, which is roughly 540 crores. Deferred achievement-based payouts over the next 2 years amounting to almost $95 million, which is another 790 odd crore rupees. So you add both of them, the overall acquisition cost comes up to over 1,300 crore rupees. And there are additional target-based payments as well. What do they get in return for that? The company has done revenues of $37 million in CY 2022. Yes, it is growing extremely fast. In CY 20, the revenues were $8 million, but we need to see how much it can add to their overall potential. Because, for Sonata Software itself, the revenue in the third quarter was around 2,300 odd crores. The cash on their books is close to around 600 crores. So the upfront payment will take away their entire cash. So we need to see whether it is expensive or not, how the street likes it. But some part of the street was also sussing this, because 14% up move in Sonata Software this month is what we saw. The exchanges had also asked them for clarification on why there was a volume spurt on the counter.
Okay, thanks a lot for that. So that's on Sonata Software. The other stock that we are looking at this morning is Greaves Cotton. Now, Greaves Cotton has announced a leadership expansion across various verticals, retail, finance and the e-mobility business. They've appointed Mr. Narsimha Jayakumar as the CEO of the retail business, and he has great pedigree. Earlier, he was the MD of Brainly India, the CEO of Akash EduTech, as well as the vertical head of Google India. So that's the first change they've made. They've also appointed Mr. Sandeep Divakaran as the CEO of Greaves Finance. Earlier, he was heading Ola Fleet and he was the head of strategy at Ola Electric as well. And they've appointed Mr. Chandrasekhar Thiagarajan as the CFO of Greaves Electric Mobility, the main growth driver for the company. He was earlier the Chief Financial Officer for Birla Soft. So they've made a lot of changes. They've expanded their leadership. And the growth areas that they've identified are: one, to develop clean mobility solutions, two, to build a future-ready portfolio of businesses, and to build dynamic technologies through continuous innovation. So I'm watching out for the stock. But, just to put it into perspective, if you look at the last 3 years of Greaves Cotton, it has done nothing for investors. It's been very flat.
Okay, all right. Yeah, absolutely nothing. In fact, it's corrected a large deal from the recent peak. Nimesh joins in there to tell us about Entertainment. Nimesh, not too great news coming in for them.
Well, not too great news. So expect the stock to start in the red for sure to start with. Now, yesterday, NCLT has admitted IndusInd Bank's insolvency plea against Zee Entertainment. Now, what this means is, according to IBC, once the company is added to insolvency, a moratorium kicks in, barring any assets, any transfer of assets. Now, reacting to this, Puneet Goenka last evening put out a statement saying they are committed towards the merger with Sony, and they will take all the required measures to achieve the timely completion of the merger. UBS has put out a note today morning. They have a buy rating with a target price of 350, but they believe that the amount in dispute, which is only 83 crores, is not material, but this can further delay the merger process. In fact, they have a couple of options as far as Zee is concerned. One, to move against this order in NCLT and squash this order, or pay the amount in dispute for the settlement to go through. So clearly a negative to start with, but this will clearly defer further delay the merger with Sony, at least for the time being.
Okay, thanks a lot for that. So that's Zee Entertainment, very important there. But Orient Cement is the other one that we're going to focus on this morning. Nigel, why is that?
Well, Orient Cement, a couple of factors playing out here. There was a hope that, in fact, they'll go ahead and they'll expand capacity in Maharashtra, because a couple of years ago, that's in 2021, they had signed an agreement with Adani Power of Maharashtra. And the hope was that they'll set up a 2 million ton plant out here. However, now Adani Power Maharashtra, they have requested the company not to pursue any further movement on this front. And also they've said that they've not been able to obtain the required clearances. So on the back of that, maybe a bit of a dampener, but I'll tell you what, no analyst was factoring in anything coming out of here. So if it did come, it was a bit of a hope out there. But since it's not going through, maybe in fact some red on that one. Well, let's hop across to Vivek. Vivek, you're looking at some stocks and news?
Well, absolutely right. So, HG Infra is the stock in focus. The company has emerged as the lowest bidder for a tender floated by RVNL. This is for a project based in Himachal Pradesh. The HG Infra bid was at 466 crore, and that at the end of the December quarter, the order book was well over 11,000 crore. Other stock on our radar is Delivery. Yesterday, Tiger Global further paid its stake in the company. At the end of December quarter, they held 4.68% stake, and yesterday they sold around 1.6% stake. So some more selling pressure and some more supply coming in there. Lastly, Lemon Tree, has gone ahead and signed a license pack for a 47-room hotel in Bhopal, and by December 2023, they expect this particular hotel to be operational.
Okay, all right. Thanks a lot for that, Vivek. Well, let's focus on Sandur Manganese as well. We normally don't track the stock very much. Remember, they are into iron ore mining as well as manganese ore mining. And now they're saying the CEC, they've accepted their request, and they've got the approval for going ahead and enhancing capacity out there. On manganese ore mining, it's going to go up from around 2.8 lakh to around 5.8 lakh. So that's close to around 300,000 tons more. So expect that stock to open up in the green.
Okay, that's on Sandur Manganese and Iron. But let's take you through a quick recap of our top stocks. Stocks with positive news flow, there's Gujarat Gas, Mahindra CIE, Greaves Cotton, AG Infra, Lemon Tree Hotels and Sandur Manganese. While stocks with negative news flow, there's Sonata Software, Z Entertainment, Orient Cement and Delivery. We'll take a quick break. On the other side of the break, we have Aditya Suresh, who is joining in from Macquarie. He'll give us a fundamental stock analysis. We'll also connect with Rajendra Gogri of Aarti Industries to discuss their Q3 numbers and the business.
A rough ride that awaits us. Yesterday we ended a little bit lower. Today we're likely to start off in the green, but it's expiry, so things could get rather volatile. Well, it's a good time to get a chat going on the markets as well as fundamentals as well. We have Aditya Suresh, the head India research and strategy at Macquarie, who joins us on the show. Hi Aditya, good to speak to you after a while. Well, the last time we chatted, you said 2023 could be a bit of a down year for the Indian markets, and it seems we're in a bit of a tizzy. Yields are going higher. The fear is that Fed will keep rates higher for longer, and valuation-wise, we're not cheap. What's your sense from here on? I mean, 2023, what kind of a downside does it open up?
No, thank you for having me on the show. I still would maintain the view, quite frankly. So we still see downside here to whether it be earnings growth, and that therefore kind of leads to kind of a lower kind of outcome here for markets. So if I kind of just lay it up a little bit, so if I think about markets as three pillars: earnings growth, foreign flows, domestic flows, even kind of excluding the valuation piece. Earnings growth, there's high numbers still baked in, and there is downside here to kind of work through still. Foreign flows remains anemic. Domestic flows incrementally, I think that could be a challenge given kind of higher rates. And so on, say, over the next, say, 12 months, we still are more cautiously positioned on Indian equities.
Okay, cautiously positioned on Indian equities. That's interesting. Aditya, good morning and thanks for joining in. What do you do with banks? A, what is ailing banks? I mean, the Bank Nifty is down almost 10% from its highs last year. And B, is this a good time to be buying some of the, retail-oriented private sector banks? Or do you think one can get better levels in the months to come?
So I think banks is an area where we are selectively positioned. In terms of the data in itself and earnings estimates, there is going to be still strong growth, which we at least forecast. So we're sticking with the larger kind of private banks. I think what's really happened so far this year, and I think this is broadly a reflection for what's happening in markets as well, is that expectations have been high. Positioning has been high, expectations have been high, and simply meeting expectations does not really give you outperformance, right? So I think it's more that it's more a reflection of that. Plus, there's a view that like to the extent we have margin compression that not being kind of fully baked in. Probably that's kind of playing itself in the bank stocks, but I think the main theme there is about expectations being full to start with.
Aditya, hi. Good morning. So, at what point will some of these excesses correct? I mean, I'm trying to put a numerical, quantitative sort of estimate to this at an index level, for example. Is it another 5-7%, 10%, 15%? By when will it become more attractive? Go on.
Yeah, no, so from a MSCI India perspective, what we had kind of called for at the start of the year was a 10 to 15% pullback for 2023. We're down about 6%. So I still think there's about 8 to 10% to go before broader markets become attractive. Against that backdrop, Prashant, I think that there's still areas of interest, right? So, but a broader kind of market in itself, we still expect some pullback here.
All right. But a couple of other names, Aditya, that you're both fairly positive on. I think HCL Tech from the tech space, from the two-wheeler space, I think TVS Motors is something that you like. So if there is a correction, there'll be good entry opportunities, right? Give us a couple of themes that you like.
So I think themes in itself, for example, in the IT space, one of the areas where we've been a bit more anti-consensus kind of positive has been that we think that the cuts to margin are done, margins are bottomed, and actually we see some margin expansion here, which is yet to be kind of reflected fully in estimates. We still, again, one comment is about earnings, the other comment is about kind of, is this priced in? Because we like the industrials, we like kind of the credit growth kind of upcycle story with the banks as well. But it still comes back to the bottom up and kind of is this priced into the stocks. So if I can leave you with kind of where we see the best kind of earnings growth, if I may, that still would be the banks at the margin. I think consensus to kind of conservative here on the IT names. Industrial selectively we still like.
Okay, so you're saying you like industrials, you still prefer banks despite the fall, and on IT you're on the fence, is it?
Now, IT at the margin, so we are positive on IT.
Okay,
we are above
positive on
consensus
IT.
here on both margin and revenues.
Okay. All right. We'll leave it at that. Aditya, thanks a lot for stopping by and speaking to CNBC TV18. Appreciate your thoughts. Well, let's move on and get you the first corporate on our radar today. Aarti Industries is what we're going to talk about and talk to. The company reported a decent set of earnings for Q3. The profits and EBITDA surged while the margins also expanded sequentially. It was above street estimates. Rajendra Gogri, who's the chairman and managing director at Aarti Industries, joins us now. Mr. Gogri, in the 9 months of this year, it's a pretty healthy growth. I mean, it's almost a 24% growth that you've seen in your top line. Can you tell us how has demand been so far in Q4, especially on the dyes and the pigment side? How long before, the recovery comes through entirely? And what kind of growth are you looking at in FY24?
Yeah, no, dyes, pigment and other discretionary, the demand has been slow. But we see that the recovery happening in partly in this quarter and next 2-3 quarters. I think discretionary demand should reach to a normal level. And over next 2 years, we are expecting about 25% CAGR growth in EBITDA. The FY24 growth may be around 20% and FY25 around 30%.
So FY24 growth is 20% on the top line, is it?
No, it is. Generally, we are looking at more at EBITDA and bottom line because top
EBITDA,
line varies
okay.
with the crude prices.
Of course.
And the top line is not that much dependent on the profitability.
Okay, so got it. So FY24 EBITDA growth, are you looking at 20%? Can you tell us how much is the discretionary segment as a percentage of revenues? I'm asking because if there is a slowdown there, which could perhaps take a few quarters to recover, then will that slow down your overall growth as well?
Yeah, generally we are on 50% discretionary and 50% agro and pharma. And that's why we are targeting around 20 for the next year, looking at the slowdown, and more towards 30 in the subsequent year.
Okay, all right. Hi, Mr. Gogri. Thanks so much for joining in. Well, sir, I understand for the next few years, you have a big capex plan of around 2,500 to 3,000 crores. So a couple of details I'm asking you for. One is, what is the current debt in books? And how do you fund this expansion of around 2,300 to 3,000 crores? Go ahead.
Yeah, current debt equity is around less than 6. And this funding for this expansion will be both from internal accruals as well as borrowing. So our target is around 3,000 crore capex in next 2 years.
Okay. So how much? So 50% of it will be debt?
Yeah, I think it will be of similar style, yes.
Okay.
Mr. Gogri, good morning, Prashant here. I have a slightly broader question. From a stock market perspective, stocks across the chemical industry have pulled back quite sharply. From a business perspective, sir, could you, the reason why people got very excited over the last couple of years is that they saw a big opportunity as China recedes and manufacturing out of India, etc., picks up in a very big way. Is that as a theme intact if you look ahead over the next 5-10 years, is that changing? I mean, we need to kind of readjust expectations. I just wanted to get a broader sense from you to begin with. Go on.
No, that is a very structural change. When people talk China plus one for chemical, India is virtually the only one. And there is definitely a demand from global customers of chemical from India. And that's why, like company like us are putting a lot of capex. A lot of other companies are also putting capex. So that is a very structural thing and at least should continue till 2030. So I think
Okay. All
there
right.
is no change in that.
Okay, got that. Are there any more margin levers for you on the upside? You have signed that long-term agreement with Deepak Fertilizers for nitric acid. How much cheaper could it be for you and how would that aid your margins? Is there scope to go above the 16-17% band?
Yeah, we have this raw material-based formula with Deepak Fertilizers. So that kind of gives a steady, visible pricing. And it will be definitely cheaper than the normal market prices. As far as the margin is concerned, margin changes with the raw material prices. At constant raw material prices, we expect our margins to go up going forward. As the new products will be more value-added products from the capex what we are planning in next 2 years.
Okay, all right, Ms. Gogri. So from the 17% odd margins that you have done in the first 9 months odd, you're expecting it to go higher, right? In Q3 as well. So could we work with an expansion of around 100 basis points odd?
Okay, welcome back. We're just counting down to the pre-open session. 10 minutes out to the pre-open. SGX on your screen. About a 40-odd point uptick after a complete collapse that we saw yesterday. Anuj is here in the studios to run us through what he's making of things. Anuj, hi, morning.
Morning, Prashant. And I think this 40 points will be evaporated very soon. That's my sense. It's been a really nightmarish series, very volatile. The Nifty may have only fallen 300 points, but it feels worse than that. And that's because the broader market has completely capitulated. In fact, the Nifty Next 50 is down 3,000 points in this series, which is around 7%. Of course, bulk of that is because of the Adani Group stocks and the large presence is entirely possible. And the Bank Nifty is extremely weak. In fact, if you see the close on Bank Nifty, that was extremely bearish. First close below 40,000 since October 2022. So almost 4 months of bearishness over there. And again, 200 is simple moving average, place at 39,100. I think should be clear over there. And selling on failure of any rally has been the strategy which has been working on Bank Nifty, and I don't see any reason why that should change on the expiry day.
Okay, all right. Thanks a lot for that, Anuj. Well, let's get in our technical experts. We have Sudarshan as well as Mitesh who join us. Morning, gentlemen. Sudarshan, you go first. We're clearly breaking down, trading below most technical levels. What's your view on the index?
Good morning. Well, I'm very pleased. Yesterday morning, we had given a very clear-cut idea: go short in the market. There was no ifs and buts. And naturally, no one expected the market to fall like this, but a decline was expected. So some days we get lucky. Now, all of you know that this market doesn't do this every day. Every day we don't expect big trending moves. And today, the chances are that markets will go into a huddle. The Nifty will become choppy. See, after this big decline, there is always a question: are we good for more, or will there be a relief rally? So the chances are that both sides will keep on battling it out, and the markets itself will not show any big signal one way or the other. So today, the best trade is to step out or take entertainment trades. Take some small trades, whichever direction you want, but keep the volumes very small.
Morning, guys. Sudarshan, when you say entertainment trades, you mean...
That's the first time I'm hearing something like that, entertainment trades.
You mean...
It doesn't become very entertaining if you lose the money, right?
No, but Sudarshan, you mean like PVR or those kind of, or you meant it in jest?
No, I meant it in jest in the sense that if you trade 20 contracts, trade one contract just to keep yourself entertained. That's all.
Okay. No, got it. As they say, pure traders सौदा तो खड़ा होना चाहिए. Up or down, 1 lot, 2 lot.
There's that itch, right? That you have to do something in the day.
Just to keep track of things. Mitesh is with us as well. Mitesh, hi, morning. I mean, I think it was a profitable day for you as well yesterday. And so a clean day, a down move in that sense. What's your sense now?
So, good morning, Prashant. I think, yes, we were looking at 17,500 being tested, and eventually I'm looking at a break below that. Now, yesterday we got a low of around 17,530 and mildly bounced back from there. And then today we might get a 40, 50 point kind of a gap up. I think the overall trend direction bias remains on the negative side. And therefore, I think, bounce back and rallies would be selling opportunities. Now, one trader has to determine is at what levels I think shorting could be a good idea. I think around 17,650 on the spot, which is roughly about 100 points higher, is where I think, I'm most comfortable. Otherwise, we'll hold on to our balance short positions. And on the upside, I think 17,750, 800 zone will now be very difficult for the markets to cross. And eventually, I think we should break below 17,500 and test the 200 average, which is around that 17,330, 350 zones.
In terms of individual trades, Sudarshan, what do you have on your list?
Well, I have a larger list of long side trades, but that doesn't mean I expect the markets to go up. It just is it's so oversold, a relief rally could come. So eventually, I would say TVS Motors is a buying opportunity. It's an outperformer. Look to buy it at 1100, the 1100 stop. Berger Paints is a buy. It's making a very attractive bullish pattern, but keep it as a positional trade rather than an intraday trade. Stop under 560. My only intraday short is Canfin Homes, which has been weakening. So that's an intraday short with a stop above 572. And ITC is a buy after that big rally. ITC has not come down while all this carnage was going on. So ITC could be an outperformer. Buy with a stop under 378.
Okay, Mitesh, what about you?
I have a mix of buys and sell calls. On the buying side is Dalmia Bharat Cement. Keep a stop below 1890 for targets of 1960. And L&T Finance has come on to very strong support levels. So it could give a bounce back, if not a big reversal. So buy here with a stop at about 88 and a target of 92, 92 half can be looked at. On the selling side is Ashok Leyland. We had a sell earlier as well. I think the stock has triggered some kind of corrective movement. So keep a stop at 146 half today and look for a target of 137, 136. And Astral is the other stock which is on the sell list, breaking down from a contracting triangle pattern. This is a sell with a stop at 1900 and a target of around 1750.
Okay, we'll take a quick break on that note. Thanks, gentlemen, for giving us those ideas. We'll come back with the pre-opening rates. Also, we'll have Abneesh Roy of Nuvama Institutional Equities to put focus